When a financial crisis breaks out, the first scene is always the same. Politicians rush, sweating, to the microphones, and bankers wear solemn, thoughtful expressions of regret. Thousands of pages of laws are passed overnight in parliaments. On top of these laws are written slogans in bold letters like protecting depositors, ensuring stability, or transparency. Yet, when you delve into the spirit of these laws, you realize they are actually lifebuoys built to keep the institutions that caused the crisis alive. History shows us that laws are not enacted to protect people, but to artificially restore confidence in the banking system, that is, its fuel. The system is never broken. It is designed to make the powerful stronger and the weak more vulnerable with every shock. One of the craftiest moves in financial history took place in 19th century Britain. At that time, the banking system was like a wild jungle. Each bank issued its own banknotes, and credit expanded uncontrollably. The result was inevitable: severe panics. When people rushed to banks to withdraw their money, the solution presented was the 1844 Bank Charter Act. The public was told, "Your money is now safe, the currency will be stabilized." In reality, this law monopolized the Bank of England's authority to issue money. Small banks lost their right to print their own currency. The result? Competition was stifled, financial power was concentrated in a single center, and the government-selected bank gained untouchable status. The issue was not about protecting a citizen's few pennies. It was about fixing financial power at the top of the pyramid. Across the Atlantic in the 1860s, the United States government was struggling with the Civil War and urgently needed money to finance it. Again, the solution came under the guise of a reform. The National Banking Acts, the rationale sounded noble: to create a safe and unified currency nationwide. But the content of the laws told a very different story. Banks had to buy government bonds in order to issue banknotes. This was one of the greatest financial tricks in history. The government had turned banks into its captive financiers. Debt was transformed into the money in the public's pockets. While the public safely held government-backed notes in their wallets, the real winners were the banking elites who financed the government's debt and earned guaranteed commissions from the process. When the world economy froze in 1929, millions of Americans saw the money they had saved over their lifetimes vanish overnight. Public anger toward bankers grew so intense that a revolution could have been expected. Amid this storm, the Glass-Steagall Act of 1933 was born. The law separated commercial banking, where your paycheck goes, from investment banking, Wall Street speculators' domain. The public was given the message: your deposits will no longer be gambled with. It worked for a while, yes, but its real success was calming public anger without changing the core logic of the banking system. Trust in the system was renewed, while banks preserved their systemic power. Decades of lobbying slowly eroded the law, and by the 1990s it was entirely dismantled. By then, banks had already become too big to fail. Also in 1933, another massive institution was created: the FDIC, Federal Deposit Insurance Corporation. The government promised that even if your bank failed, it would cover a certain portion of your money. For small investors, this sounded like paradise, but in reality, it was the bank's biggest irresponsibility certificate. Before the FDIC, a depositor had to monitor how much risk their bank was taking. If a bank was risky, people would withdraw their money, forcing the bank to act prudently. But once insurance was in place, the public said, "The government has my back. The bank can do whatever it wants." relinquishing oversight. Banks seized the opportunity. Losses would be socialized to the public, while profits would flow into their own coffers. This was a massive hidden subsidy given under the guise of protection. Perhaps the most radical step during the Great Depression was Roosevelt's bank holiday. The government closed all banks and then passed the Emergency Banking Act. This law required citizens to hand over all their gold certificates, and bullion to the government. In return, they received paper dollars. This move was presented as a patriotic sacrifice necessary to save the economy. In reality, the public's only real asset, gold, was confiscated, replaced with paper whose value was controlled by banks and the government. Property was not protected. On the contrary, it was seized to preserve the financial system. Fast forward to 2008, the scene repeats. When the colossal bubble created by mortgage-backed securities burst, the largest banking rescue operation in history began. In the U.S., the TARP, Troubled Asset Relief Program, law transferred hundreds of billions of dollars from taxpayers directly to the balance sheets of failing banks. Again, the chorus sang, "If we don't save these banks, the economy will grind to a halt. Salaries won't be paid." But when the crisis ended, the outcome was clear. Bankers continued to receive bonuses. No one went to jail. Public, millions were left homeless as their houses were foreclosed. Retirement funds evaporated. The law had not saved the economy. It had saved the elite, defined as systemic. The word system had officially become synonymous with banks. In Europe, the scenario was no different. In Ireland, Spain, and especially Greece, governments assumed the debts arising from banks' bad investments. To pay off these debts, austerity laws were passed. Hospitals closed, pensions were cut, taxes were increased. Why? To prevent German and French banks from taking losses on Greek bonds. Structures like the European Stability Mechanism, ESM, passed under the guise of ensuring stability, were in fact gigantic vaults, holding public funds ready to cover bank losses. Today, the global banking system is governed by rules called the Basel Accords. These rules are supposedly meant to limit banks' risks. Yet they contain loopholes so extensive that banks shift risk only on paper rather than reducing it. For example, a government bond is considered risk-free, even though the 2012 European debt crisis showed that governments can default. These regulations have done little more than provide legal frameworks for large banks to manipulate the system. This historical journey whispers a single truth. Money and banking laws are never neutral. In times of crisis, these laws are jointly written by governments and financial giants to keep the shaken pyramid standing. The protection of your savings exists only to provide the minimum trust required for the system to function. Today, central banks use the language of reducing inflation when raising interest rates or introduce new laws on digital currencies. Yet the true purpose remains the same: keeping financial power concentrated within the system. So, what should citizens do? True financial freedom does not come from trusting the system's forbidden or fancy promises. You must understand how the system works, and every time a new law is passed, ask, who really benefits from this law? True protection is not in paper laws. It is in building a concrete, independent asset base that cannot evaporate overnight due to the system's arbitrary decisions. The world is shaped not by those who talk the most, but by those who plan the best. Leave the showiness to others. Keep the real power for yourself. Old money is the great wealth hidden in silence.